Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. After a very impressive end of 2022 and start of 2023, it seems the S&P 500 is taking a break from its relentless run here. We're currently seeing the VIX, the volatility index of the S&P 500, that's breaking out here above this wedge type of pattern. Beautiful downtrend that we've had since October of 2022. And look at what's happening here in February of 2023. Volatility breaking out right after it tests this trend line here that we've looked at on this channel many times before, going back to 2017, marking all the important bottoms in volatility throughout the last 5 years. If you're lucky enough to be subscribed to our service on gameoftrades.net, you'll know that early last week, we added a VIX call to our model portfolio. As the VIX was tagging this trend line, we've been patiently waiting for this opportunity to arise. It came, we took advantage of it, and hopefully it's going to help a lot of people take advantage of what is currently happening on the VIX right now. But what we're really going to be focusing on in this video is whether this breakout in volatility that we're seeing right now is going to lead to a massive spike in volatility, like we've seen a few times in the last 25 years, corresponding to some of the biggest drawdowns in recent S&P 500 history, like the 2008 bear market, many of these corrections being around 15-20%. So extremely violent for anybody who's in the market and not positioned correctly. So we're going to talk about how bad things can get from here, how quickly this can all play out. Is this a question of weeks, months, years? If you are new here, don't forget to click on that subscribe button. We make these videos multiple times a week, talking about the financial markets and the economy and looking for opportunities together. And of course, if you enjoyed this episode, don't hesitate to drop us a like. It helps us out massively. Now, without further ado, let's get right into it. So the first thing I want to do is look at this trend line in a little bit more detail, see if we can spot some moments in history where we've seen a similar type of action on the VIX. Before we do that, of course, I want to remind that the VIX is the volatility of the S&P, and so the VIX tends to rise as the market moves down. You can see this is the volatility during the global financial crisis. And on the other hand, as you see the market move higher, you tend to see volatility move down. That's how the mechanics of the financial markets work. And so if we think that volatility is going to spike here, that's probably not very good news for the market. So that's just a side note I want to add here before we really dive into this. Let's look at this trend line here. This marked many tops throughout the last 5 years, 2017, 2019 right here, 2021 right here. So you can see that's very interesting, right? This is something that we've talked about before on this channel, but we've got higher highs in the market while volatility is also rising. That's not what you typically see. It's unusual. It's telling you that volatility traders are pricing in more and more volatility in the future, despite the fact that the market is moving higher. So this is, in other words, a sign of the bull run coming to its end, right? You can see as we had a healthy bull run all the way to 2017, right? The market was rising and volatility was moving down in a very healthy manner. Since 2017, we've had what you would call an unhealthy bull run, where you have volatility rising as the market rises. So that's not a particularly good sign. One moment in history where we actually had a very similar type of action, it's going to be easier to show you on this monthly chart here. It's actually in the 90s and 2000s. You had a nice trend line here from 1993, 1995, 2000, 2002. Now, it's not as beautiful as the one we have today, but definitely worth comparing these two periods, especially given the similarities that we have here compared to the market. So you can see this first big tag of the trend line right here, 1995, was a higher high, right? The market was moving higher here, despite the fact that volatility was also moving higher. Now you can see here this third tag actually marked the top of the bull market right here in 2000. So let's try and figure this out here. You have the bottom in volatility right here in 2018. Then you have the first real tag of the trend line here in 2020 as the market continues to rise. The third tag in volatility potentially actually corresponds to this tag that we had in 2000, right? A third tag of the trend line. And now look at 2002 right here. The fourth tag of the trend line was actually at the top of a bear market rally right here. So fourth tag of the trend line, is this a bear market rally? As we've been discussing over the past few weeks, it does seem, at least from our opinion, and that's all it really is, it does seem like this rally here is likely to prove to be a bear market rally. Now, it's still showing a lot of momentum, right? It's still showing a lot of strength, and it could still have some room to run higher, which is why we are still keeping some of our favorite bets on US equities in the model portfolio, even if we do have that hedge by adding the VIX call option. But it does seem from the reaction that we're getting here that this is a significant bottom in volatility. Now, how quickly is that going to turn into a much bigger spike? That's what we're going to cover in this next part, because you can see it doesn't necessarily immediately mean the market is going to top here, right? June 2021, this is a bottom in volatility. Look at where the market is. Okay, yes, you got the bottom in volatility right, but if you were short on the market in June of 2021, you would have got hurt very badly in the months ahead, because the market continued to rally for another 6 months after that, as volatility continued to rise. So that can happen. Is this something that we should expect to happen here? Don't hesitate to hit the like button if you're so far enjoying this video, if you're finding it useful, valuable, educational. That's essentially what our goal is with these videos. I love to give my opinion. I love to give my perspective on the market. But at the end of the day, the most important aspect of these videos is that you're learning something, that we're showing you a different perspective, and hopefully giving you something to think about. So as we ask this question of how quickly can volatility rise, we need to first ask the question, why was volatility so low throughout the 2022 bear market? We've had a very significant drop in the market throughout 2022, right? A very vicious bear market here throughout 2022. Volatility spiked at the beginning, but then it actually started to trend down even as the market was moving lower. That's actually pretty rare, and it hasn't happened very often throughout the last 25 years. You can see here, of course, 2008, volatility spiking as the market is moving down. You can see here from the top of the bull market in 2000 to the bottom in 2002, what was happening to volatility. It was rising. In fact, it topped out at 46 when we only topped out on the VIX at 35. And then you had so many drops here, 2010, 2011, 2015, where you had volatility spike at 45, despite actually being smaller corrections than what we had throughout 2022. So why did volatility stay so low throughout the entirety of last year, despite a big bear market? And I do have the answer to that question. Let me show you my reasoning. It is primarily because this was just a Fed-induced bear market. This is the 2-year yield, so short-term rates. And so market valuations are basically a derivative of what short-term rates are doing, which is a derivative of what the Fed is doing. So as the 2-year yield rises, it rose to around 4.5% back in October. What happens to market valuations as that discount rate rises? Well, valuations go down because all of a sudden cash is more attractive. Stocks can't stay extremely expensive when cash is yielding 4.5% per year. So it really hasn't been a panic move down in the market. It has really just been a byproduct of the discount rate rising very quickly, and so valuations falling quite quickly throughout 2022. And so although it has been painful for anybody in the market, it has been quite a steady, predictable market trend as valuations rise and the market moves down. How does that differ from anything that we've seen throughout the last 20 years? Also in 2008, the market was not moving down because the Fed was tightening. So it's very, very different type of market environment to what we saw here in 2022. Here, the market was moving down because the economy was tanking. S&P 500 earnings were contracting, and so companies were making less money. Unemployment was rising. People were cutting spending. And so why would you be in stocks when companies aren't making money and the risk of default is rising significantly? So all the spikes that you see on this chart, right? This is the log-based chart of the VIX. All the big spikes here that you see are a direct result of the economy, are directly linked to the economy tanking, to earnings contracting, and to investors fleeing the market because of that. 2002 recession, 2008 recession, 2011 earnings were in trouble, 2015 earnings were in trouble, 2018 earnings were in trouble, and of course 2020, the entire world was shut down, and so earnings were in trouble. So where does that leave us today? If you read our macro note that we posted a couple of weeks ago, our earnings model for the S&P 500 is currently telling us we are heading towards a contraction in earnings, which is not at all in line with what analysts are estimating here for next year. Right, and that makes sense. We've had a massive tightening cycle here in 2022. Since March of 2022, the Fed has been raising rates significantly. That is going to impact the economy at one point. And the yield curve that's the most inverted since 1981 is telling us that the bond market expects that this tightening is going to hit the economy very soon. That's why yield curve inversions systematically predict recession, because the bond market typically anticipates that ahead of time. So it does seem like this year, the odds that we do see a larger spike in volatility has risen significantly. Make sure to stay up to date on any changes that we make to the model portfolio, when we're looking to add, remove positions, what the current dynamics are. All of these updates are short, concise, straight to the point, so that you can extract a maximum amount of value as quickly as possible from your membership. By the way, it is Valentine's Day tomorrow, so if you're looking for the perfect gift for your loved one, you can purchase our gift card on our website at gameoftrades.net, show you care about their financial well-being, and give them access to our investment strategies, our model portfolio, and our data-driven research. Now, I hope you guys enjoyed this episode. If you did, don't forget to smash that like button and click on that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading, and see you next time.